U.S. tariff storm hits Canada, America at risk.
Canada's economy shattered. U.S. wallets next.
Trade war escalates. Your price is about to jump.
Canada under economic siege and Americans suffer.
Within weeks, Canada's factories began whispering something's wrong. Exports slumped, inflation crept up. The Bank of Canada now warns U.S. tariffs have shaken Canada's economy and drained productivity in critical sectors. But here's the twist. You in the U.S. will feel this too. In your grocery bills, your mortgage, your job prospects. Why is a battle in Ottawa about to hit your life in America? Stay close. This isn't a diplomatic disagreement, it's a financial earthquake disguised as policy. On March 4, 2025, President Trump announced a fresh round of tariffs targeting Canada and Mexico, 25% on steel and manufactured goods, 10% on energy exports, 5% on select agricultural products. The White House called it a necessary defense of American industry. Ottawa called it economic sabotage. Within days, markets shuddered. The Canadian dollar fell below 73 US cents, its lowest since 2020. Exporters froze shipments awaiting clarity. Steel producers from Hamilton to Alberta reported contracts canceled overnight. This wasn't a paper policy, it was a real-time hit on factories, truckers, farmers. By August 2025, Canada's trade deficit had widened to 6.32 billion dollars, its second highest on record. Exports to the U.S., which make up 75% of Canada's outbound trade, fell 3.4% in 1 month. Industrial machinery dropped by 7%, autos by 5%, metals by nearly 10%. And remember, every percent lost north of the border means slower production and higher prices south of it. Canada's GDP shrank 1.6% in Q2, following a 2% decline in Q1, a technical recession. Capital investment fell sharply as business confidence collapsed. Factories reduced shifts, housing construction paused, consumers held back spending as interest rates stayed elevated.
In October, the Bank of Canada sounded the clearest warning yet. Deputy Governor Carolyn Rogers told reporters that U.S. tariffs had shaken Canada's economy to its core and that productivity in key export industries was falling at a rate not seen in 2 decades. She wasn't speaking metaphorically. Output per worker in manufacturing had slumped 4.7% since spring. Energy exports to the U.S., Canada's lifeblood, were down 8% year-on-year. And when productivity slides, so does living standard. Canadian real wages stagnated despite inflation hovering around 3.5%. The bank faced an impossible choice: cut rates and risk currency collapse, or hold steady and crush growth. It chose caution. Growth crumbled instead. Canada's 6 major banks control about 93% of national financial assets. They're stable, but not nimble. Rogers warned that overregulation was choking innovation precisely when resilience is needed most. When trade contracts shrink, banks tighten credit. Small and mid-sized exporters, the backbone of employment in Ontario and Quebec, suddenly can't roll loans. That means layoffs, that means defaults, that means fewer imports from America. Canada and the US don't just trade goods, they build them together. Each auto crosses the border up to 7 times before final assembly. When Canada's plants slow down, US suppliers in Michigan and Ohio lose orders. In September alone, auto parts exports from the US to Canada fell 5%. That's real jobs in Toledo, Detroit, Cleveland.
Energy is no different. Roughly 10% of U.S. refined fuel supply depends on Canadian crude. As tariffs distort flows, prices on U.S. wholesale gasoline contracts spiked 7% by late September. Those numbers don't sit in economic reports. They show up in your utility bill, your commute, your grocery truck's freight surcharge. Both governments are digging in. The Trump administration frames the tariffs as leverage for better deals. Ottawa responds with measured retaliation. Temporary tariffs on American dairy and grain, symbolic but psychologically potent. Behind the scenes, Canadian officials are exploring sector-by-sector pacts to circumvent Washington's blanket duties. Finance Minister Chrystia Freeland privately admits the government is playing defense with one hand tied. Meanwhile, U.S. industries that depend on Canada, from construction to agriculture to retail, warn of ripple effects. The National Association of Home Builders estimates lumber tariffs alone have added $1,200 to the average American home price since spring. Steel buyers say supply delays are stretching project timelines by 20%. And this is before winter, when construction slows and costs climb. Ottawa has rolled out a $10 billion relief package for exporters, offering low-interest loans and tax deferrals. But critics say it's a band-aid on a bullet wound.
Manufacturers warn they can't compete with U.S. subsidies or tariff walls. Foreign investors are pulling out. Since May, direct investment in Canadian manufacturing has dropped 14%. And when foreign money leaves Canada, guess where it looks next for safety? U.S. markets. That spikes the dollar, strengthens the Fed's hand, and makes American exports more expensive globally. A double blow.
Behind the numbers is a dangerous loop. Tariffs hurt trade. Lower trade hurts productivity. Weak productivity lowers investment. That weakens growth, shrinking demand for U.S. goods. And when the U.S. feels the slowdown, it responds with more tariffs and monetary tightening, feeding the cycle again. It's an economic echo chamber where each retaliation becomes another recession signal. In Hamilton, steelworkers describe layoffs as rolling blackouts of hope. In Windsor, auto parts suppliers say orders from Michigan have slowed to a crawl. Farmers in Saskatchewan can't sell beans to U.S. processors without massive tariff penalties. Across the border, truckers in Minnesota and North Dakota report 20% fewer freight runs north. The entire continental supply chain is catching a fever with a shared temperature. And this is just the opening act. Canada's financial stress has barely begun to transmit southward through credit lines, currency markets, and investor sentiment. When the second wave hits, it won't be about exports or imports, it'll be about liquidity, confidence, and trust. Because when your closest ally and largest trading partner starts to crack, you don't stand safe, you stand next in line. Part 2 dives into the domino effect, how Canada's banking tremors could rattle Wall Street, spike U.S. inflation, and force Washington into an economic crossfire of its own making. The first shock hit Canada's factories. The second is about to strike your wallet.
By early October 2025, Canadian credit data showed a sharp deceleration. Commercial lending volumes dropped 6% quarter over quarter. Export-dependent small firms were defaulting at triple the pre-tariff rate. The Bank of Canada estimated that 15% of national bank assets are tied to companies directly exposed to U.S. trade flows. That means $1 in $6 in Canada's banking system now rides on the outcome of this trade war. When those borrowers struggle, liquidity tightens, banks hoard reserves, credit spreads widen. And guess who holds exposure to those same Canadian lenders? Dozens of U.S. regional banks, pension funds, and insurance portfolios. Cross-border lending lines are deep, roughly $1.2 trillion in shared assets and securities between both nations. If even a small fraction turns distressed, the repricing of risk sends a chill through New York, Chicago, Dallas. Canadian bond yields have already surged at the fastest pace since the 2008 crisis. That rise dragged up yields on U.S. corporate paper as investors demand higher returns for anything North American. Result, borrowing costs climb for American manufacturers, home builders, and consumers. A trade war morphs into a credit war. Remember, Canada supplies nearly 1/5 of America's imported raw materials: lumber, metals, energy feedstocks. Tariffs push those prices higher. By late September, U.S. data showed a 0.7% monthly jump in goods categories linked to Canada. Lumber, aluminum, and auto components alone added 0.3 points to headline inflation. For an American family already spending $700 more per month on essentials than in 2020, that's the blow that turns strain into pain.
Now factor in logistics. Freight rates on the Detroit-Windsor corridor are up 18%. Energy traders report 7% higher wholesale gasoline prices as crude shipments slow at border terminals. Every stage of the supply chain is paying a tariff toll. Scenario 1. Temporary truce. If Washington and Ottawa strike a limited deal, exemptions on steel and autos, the bleeding could stop. Analysts project Canadian growth could recover modestly in 2026 if tariffs ease by spring. U.S. inflation would cool within a year, but even in this optimistic path, business confidence will take years to heal. Scenario 2. Prolonged conflict. If the tariffs stay or escalate, Canada could lose hundreds of thousands of jobs within 12 months. Its GDP could contract another 2.5% next year. The Canadian dollar might slip to 68 US cents, making imports costlier for both nations. US exporters lose buyers, margins collapse, and the Federal Reserve faces an impossible dilemma: raise rates to defend the dollar or cut them to cushion the slowdown. Either way, Americans pay, through inflation or through lost jobs. Scenario 3. Systemic shock. Here's the nightmare path economists whisper about. A wave of corporate defaults spreads through Canada's mid-tier banks. Liquidity evaporates, credit ratings fall, U.S. counterparties pull funding, global investors dump North American assets, the dollar surges, the stock market convulses, and both countries stumble into synchronized recession. Sound extreme? It's the same chain reaction that followed the 1998 Asian crisis, except this time the spark is self-inflicted.
Meanwhile, the rhetoric burns hotter than the numbers. President Trump calls the tariffs a patriotic correction. Canadian Prime Minister Mark Carney insists Ottawa will not blink. Public opinion on both sides polarizes. In the US, manufacturing unions cheer the tariffs. Logistics and retail sectors beg for relief. In Canada, inflation protests spread from Toronto to Calgary. Behind closed doors, negotiators even floated reviving the Keystone XL pipeline as a bargaining chip, energy for tariff concessions. But environmental opposition in both countries makes that politically toxic. Every potential compromise carries a new cost. Let's break the abstract into the personal. Home prices. Lumber tariffs have added roughly $1,200 to $1,500 to U.S. homes since spring. Car repairs. Imported Canadian auto parts cost 8% more, driving up repair bills. Food prices. Retaliatory tariffs on U.S. grain hurt farmers, raising domestic feed costs. 401k volatility. Cross-listed North American firms drag U.S. retirement portfolios lower. Job security, logistics, construction, and manufacturing face hiring freezes heading into 2026. Every statistic translates to a household decision: postpone a remodel, skip a trip, stretch a paycheck. Trade policy has become a kitchen table issue. Previous tariff rounds were symbolic skirmishes. This one bites because it targets a friendly economy whose supply chains are fused with ours. Unlike China, Canada can't absorb shocks through subsidies or scale, so every dollar of damage there transmits almost dollar for dollar here. When Canada coughs, America doesn't catch a cold, it gets pneumonia.
Experts outline 3 ways out: targeted exemptions, reinstate USMCA carve-outs for autos and agriculture, central bank coordination, expand Fed-backed swap lines to stabilize currencies and liquidity, North America Productivity Pact, Joint Innovation Fund to offset tariff drag. All sound plausible, yet all require trust, and trust is what tariffs destroy first. Trade wars sell well politically because they sound strong, but economies aren't battlefields, they're ecosystems. Disrupt one root and the branches wither in both countries. Trump's tariffs were meant to protect American jobs. Instead, they've made North America's supply web more fragile. Forecasts now predict that continued escalation could shave nearly 1% off combined North American GDP by 2026. Credit agencies warn of contagion risk to U.S. regional banks if Canadian credit quality keeps sliding. Bankruptcy rates among small exporters are expected to jump by a quarter within 6 months. These aren't partisan forecasts, they're mathematical consequences. If diplomacy fails, central banks will step in. Rate cuts, emergency liquidity, even coordinated QE. Markets will rally briefly, then reality returns. Tariffs are still taxes, and consumers still pay them. Look at a border map. It's not a line, it's a bloodstream. Every truck, every pipeline, every data cable carries shared prosperity. Right now, that flow is clotting, and when the blood stops moving, both bodies suffer.
America's trade war is breaking Canada's economy, but it's also breaking something larger: the quiet trust that keeps the continent functioning. The question isn't whether Canadians or Americans win, it's how long ordinary families can survive while politicians keep playing economic chicken. Because every tariff is a tax, every trade war is an inflation plan, and every collapse across the border is a warning shot at home. The sooner we understand that,